Hey everyone, so basically we had some pretty bad trades yeah, like in the past few days, and I found out what I was doing wrong, right? For example, if you guys see this over here, so I kind of found out this was what I was doing wrong. For example, like over here, right? If you guys can see this, like let me show you guys. So as you guys can see, wait, hold up. Give me a second. Okay, so basically like okay, so in this case obviously like it's heading lower, right? And then it's trying to rebalance this like swing low and then go higher, right? I mean this order block. So basically like, you know, the swing low parallel to the order block. So basically what I'm expecting here, like for example, whenever I take my trades, right? Whenever I take my trades, I always see this tap, this wick into the fair value gap, and then I would expect obviously, you know, there's manipulation here, and then I would expect price to go here, right? Like this does not happen, okay? For example, like this right here does not happen, okay? More than likely, what happens is prices does this on you, okay? Okay, no, like this, accumulation, the manipulation with the distribution, right? But like instead of doing this, it would do this, okay? So that's exactly what I was doing wrong. So for example, like I would enter here, I would wait for manipulation, I would expect price to go higher, but contrary to my expectation, what price would do is go lower and then go higher, right? So I believe you could back this up with a PD array on the lower time frames. Let's say like let's say this was a daily, okay? And let's say on the 15-minute, like once you zoom in, you might be able to see some sort of PD array right below, like even on the 15-minute, which would support this claim. So what needs to happen is the fact that you need to see a candle which is clearly displacing or like losing the momentum, for example. Like if you see a continuation, so for example, even in this scenario, right? Like even though we see this wick, right? Even though this is a manipulation wick, potentially for a distribution, this is not the case, right? The problem with this, of course, like in this case, it just goes higher and, you know, manipulates and goes lower. So if if this point was your expectation, yes, sure, it goes and hits that, as you guys can see, right? So then it basically, this is what happens within this candle, right? So this candle right here, what it does is it basically over here it just does. So let me draw like this area, okay? So on the lower time frame, so it does this accumulation, manipulation. We have a manipulation once again, and then we go manipulate again, and then it goes lower, and then it has a manipulation again, and then this move right here is what you see. Oh my god, this is getting super messy. Okay, so this right here is what you see within this, right? So this move, so this is exactly what you see in these two candles right here. Okay, so this is what you see. So this formation. So let me show you guys. So over here, like this is the first candle, the small doji, and this is the larger candle. Okay, so essentially this area is this one. Okay, I just want to get rid of all this nonsense over here. So basically what I'm expecting price, obviously when I see this manipulation, I would expect price to take it higher back towards here, right? So contrary to my expectation, like because this is the demand level order block, by the way, this is basically this one. What happens is that you need to wait for a confirmation of these lows being swept and then go higher. For example, like over here you can see the momentum, like the displacement also indicates the fact, for example, okay, now you know for a fact that this momentum is getting ever so smaller because like you see the manipulation happening here, right? So that means it's obviously reacting to it, but then is that the right point to be reacting? That's the question. So when it comes to manipulations, there's two types of manipulations. So over here, some people call this a stop hunt. So if you look at like a low time frame, for example, this is a stop hunt. You would see like equal lows getting rated, or sometimes like low resistance liquidity runs. In other words, like unbalanced lows. Like let's say for example, there's like 3 lows like this. You would take all of them and then fund the move to go higher from like maybe a PD array somewhere right below this, and then fund the move to go higher, right? So obviously in this scenario, it's no different. Basically in this candle itself, you guys can see that this is the accumulation range. You have the manipulation. So in fact, this manipulation right here is not really a manipulation. It's just an accumulation range to even go lower, induce, and then go higher. Now, this is very important because this is exactly this point right here is where I was getting induced into the market. Now, this is something that a lot of people do wrong because they see this manipulation, right? Manipulation, distribution, boom, TP, right? It doesn't work like that. You need to always wait for a loss in displacement because this is an indication of the fact that we're losing displacement, right? We're losing displacement. Maybe you could capitalize off to like over here, like let's say like if you take this trade and you could get lucky and then you could like take a partial over here because this is in fact the high time frames. For example, this is like the daily candle, the daily chart. So it does take a while to like form this, right? So obviously my idea in that scenario is not to trade when the market is at a point of interest. For example, if you are close to a PD area, like if you know that, like let's say for example, market's either going bullish or bearish. Now, if you know a thing or two about market structure, if it shifts from a sell program to a buy program with a change of character, then you can expect price to be bullish, right, on a high time frame. Now, I'm talking strictly about the high time frames, by the way. Do not I'm not talking about the low time frames. So basically, over here you can see that this is shifting from a sell program to a buy program, right? But like over here you see this market structure shift, right? So basically we're shifting from a sell program to a buy program. But the problem here, okay, the problem here is the fact that over here, right, this what was I gonna say? I kind of forgot what I was gonna say. Okay, so over here, this like, okay, now that you know the structure of the overall market structure, so in this leg, if I ask you what this leg of price action is, it's bullish, obviously, right? So in this case, like if you see some sort of PD array, let's say for example some sort of PD array, there's always some sort of a reaction off of it, right? There's always some sort of reaction off of it because price moves from internal range liquidity to external range liquidity. This is the simplest thing in the world. Okay, so basically what I'm saying is there's always a reaction off of PD area. So what I'm saying is don't trade when there is some sort of high time frame PD area that's the closest, because if you trade very close to a high time frame PD area, you will get fucked over. That's like, there's no other way around this. Okay, so basically just don't do this right here. Wait for a confirmation candle, for example a low, to be swept by another low, right, like this, as you guys can see, and then go higher towards here. Now this is pretty obvious, as you guys can see. So this is a
let me just replay that with the 4-hour time frame. So now playing out the next few candles, you can see we do form a little bit more liquidity.
See, this is what happens on the lower time frames, as you guys can see.
Right here,
so until you see a proper market structure shift, now of course you can like let's say you're going from here to here, obviously you can capitalize on it. But like if you're going for a low time frame market structure shift, make sure you see a proper market structure shift, especially if you're coming from a sell program. Market structure shift, pull back, and then make sure you consider this market maker buy model with context. A higher time frame context needs to align with your bias. That's the whole idea to really make your trades basically stick. Okay, so make sure you stick this. Okay, don't pay attention to the worst kind of mistake that you can make is only look at market maker models. For example, you look at the sell side of the curve, buy side of the curve, market maker buy model. No, don't look at it like that. Always, even in a scenario where you compare it with high time frames, you could be wrong, right? So what I'm saying is always have the higher time frames in your odds. Basically higher time frames in your favor. So basically right here, as you guys can see, this manipulates this. So obviously what I'm seeing here is something like this. So for example in this candle, right, starting from this candle, so you can obviously see there's a drop like this, and then you see another further drop, and then you go higher. Now this is the point where when I see some sort of small reaction off of this point in time, that's when I would expect to take the price higher, right, towards like a draw on liquidity. Sure, it might do this, but if you are targeting something like this, then it would obviously have to fuel the move and go higher. Now in this scenario, ideally I would say stay for it lost in displacement. As you guys can see, it loses displacement right here, and then it shifts from a sell program to a buy program, and then you target this as your TP. So that's pretty much it, guys. Small little video that I wanted to make so I can show